All right, let's get right into it. For months, it really seemed like the U.S. economy was just defying gravity. But the latest numbers just hit, and, well, they are telling a very different story. We're talking about a major and kind of sudden slowdown.
And this is the number that has everyone talking. Economic growth last quarter, just 0.7%. To give you some perspective, that is a huge drop from the pretty strong 3.4% growth we saw just the quarter before. It's way, way below what most economists were expecting. This figure basically just slammed the brakes on that whole booming economy narrative.
So, yeah, a number that low immediately brings up the biggest question of all. Are we heading for a recession? That's the big mystery we're going to try to unpack here by looking at the clues the data is giving us.
Okay, so let's start with what we actually know for sure. The latest data confirms it. The U.S. economy is cooling off, and it's happening pretty significantly. But what does that really mean in practice?
Well, it means the whole engine of the economy is just running a lot slower. And we're seeing this pretty much across the board. People aren't spending as much, businesses are holding back on making big investments, and even manufacturing is slowing down. That momentum we had going, it's clearly faded.
Now, before we go any further, we have to make sure we're all on the same page about the main character in this story, GDP. So let's do a super quick 60-second breakdown.
The easiest way to think about GDP is like a country's annual report card. It adds up the value of everything we produce, from cars and software to haircuts. When GDP is growing, it's a sign of a healthy economy. Businesses are expanding, the job market is strong. But when it slows down, like it has now, it's a huge warning sign that things are cooling off.
Okay, so if the economy's slowing down, the next big question is why? Let's put on our detective hats for a minute and investigate the main culprits behind this cool down.
It's really a three-part story. First up, the Federal Reserve has been keeping interest rates high to fight inflation. That makes it way more expensive to borrow money for a car, a house, or for a business to expand. And that leads directly to number two. Consumers are getting a lot more cautious. When borrowing costs are high, spending on those big-ticket items slows right down. And finally, this isn't just happening in a vacuum. We're still dealing with global pressures, like economic weakness in other countries we trade with, or those stubborn supply chain issues that are still making some things more expensive.
So, a slowing economy can sound kind of abstract, right? But it has very real consequences. Let's shift gears and talk about what this actually means for the stock market and, maybe more importantly, for jobs.
You can really feel the mood change in the market. As soon as the economy shows these signs of weakness, investors get anxious. They start worrying that if people are spending less, company profits are going to go down. And that kind of uncertainty, it almost always leads to a more volatile, jumpy stock market.
And what's fascinating is the split we're seeing. On one hand, you have investors pulling back, moving their money into safer things like government bonds. But at the exact same time, there is still a ton of optimism around resilient sectors like tech, and especially artificial intelligence. Those areas continue to show incredible growth, even with the broader slowdown happening.
So this is the really crucial part. How does this affect everyday life? Well, a slowdown like this could mean that job creation starts to slow, businesses might decide to delay plans to expand or invest, and all of this can weaken consumer confidence. But, and this is a big but, it doesn't automatically mean a recession is a done deal. The economy has still shown some real strength in other key areas.
All of this brings us to the big cliffhanger. Right now, all eyes are on the Federal Reserve. They're facing a really critical, high-stakes decision about what to do next.
And here's their massive dilemma. If they cut interest rates, that could help stimulate the economy and stop a deeper slowdown. The risk? Inflation, which they fought so hard to bring down, could just flare right back up. But on the other hand, if they hold rates steady to keep fighting inflation, they risk pushing this slowing economy right over the edge. They are truly walking an economic tightrope.
Because of that tightrope walk, the next few months are going to be absolutely pivotal. You can bet that policymakers, investors, everyone will be watching every single piece of new data on inflation, on jobs, and on spending, looking for any signal about which way the economy is really headed. And that leaves us with the final, huge question. Is this 0.7% figure just a blip on the radar? A temporary pause before things pick back up? Or are we watching the beginning of a bigger, more fundamental shift in our economic landscape? For now, the story is still being written.